Hello and welcome back to the channel. Back today with another stock analysis, and this time we're going to be analysing Amazon, coming up with an intrinsic valuation and expected rate of return for Amazon stock. If you haven't already, hit that subscribe button and click the notification bell so you can see more investing and analysis videos such as this one. Also, if you enjoyed the video, please be sure to leave a like as it helps the channel greatly. Okay, so our aim in this video is essentially to find out whether Amazon stock is still a buy in 2021 at the current price. In order to know that, we have to come up with an intrinsic value for Amazon and an expected rate of return to see if it is one, undervalued, and two, meets our minimum acceptable rate of return. On this channel, it is 15%. To do so, I will be creating a valuation model for Amazon from scratch. So we are going to jump straight into the numbers in this video, as I'm sure everyone is very well educated on what Amazon does and its business segments, unless you've been living under a rock. I will, however, talk through some of the business segments results and also the potential catalysts for growth once we have scanned the numbers, because it's going to be an important part of the valuation. Just before we look at our spreadsheet, I want to point out a few things, mainly to do with these segmented financials. It's important to know where the income is coming from. So this poster here is quite useful. It breaks down Amazon's revenue by business segment or product and lists the competition in each market. I wanted to show you because it demonstrates really how big Amazon's footprint is in the world internationally, not just as a retailer, but so much more. You can see just by looking at the people that it competes with. I mean, you've got Visa, MasterCard, Google, Walmart, Costco, Netflix, Disney, Apple, Google Cloud, Azure, eBay, Etsy, JD.com, Walmart again. How well diverse its business model really is. This will no doubt be one of the key factors in Amazon continuing to grow, even at the size that it already is. It's also good for me to visualize this, as it does help make sense of some of the very large numbers we're going to see in the valuation, and I think it would be good for you to do also. With a footprint like this, larger numbers are quite easy to make sense of. Now, another interesting thing to consider here, Amazon only makes up, and I say only just because of how big its footprint really is, 4.6% of total US retail sales by the end of 2020. That number definitely has room to grow, I will say that. So that probably tells us that the e-commerce or retail part of the business isn't quite done yet, and we can see that in its growth rate. If we look at the business segment by revenue, I know we just saw it on here, but this is a little bit of an easier way to look at it. Online stores, third-party selling services is the largest. That means really that retail dominates in terms of sales. Amazon Web Services and subscription tend to be a little bit smaller. However, if we look at earnings and free cash flow, earnings for now, AWS makes up around 60% of the earnings, which is only, the third largest product by revenue. However, it is extremely profitable with an EBITDA margin that sits around 30%. Okay, now let's look at Amazon's past performance to get an idea of growth and margins into the future. Firstly, let's focus on revenue up here at the top. So one of the most impressive top-line growths you'll probably see, one of the most impressive I've seen, an already large 48 billion to 347 billion in less than a decade. That's an annualized growth rate of 26%, as you can see. However, what I find just as interesting is earnings have grown from 1.9 billion, so already a very positive number, to 43.7 billion, which is an annualized rate of 38%. Now, this shows that earnings have been growing quicker, at a quicker rate than revenue, which is great, not only because earnings are growing, but because it shows margins are improving over time, most likely due to scale. And this is something that we will obviously factor into our forecast as Amazon gets bigger into the future. Now, another point to note in terms of profitability is this little segment here that I've included. So Amazon's R&D spend has always been huge. I mean, I remember reading a book and looking at articles that dated back to around 2003, 2004. I mean, I wasn't looking at them then, but I mean, reading them about a year or so ago, where people were valuing Amazon with margins that excluded the cost of its R&D spend, just because they were so big compared to the sales amount back then. It was mentioned also in the book 100 Baggers, as it was seen as adding value back into the business by helping it grow, essentially acting as an investment rather than a cost. You may think it seems crazy to back out R&D. However, if you look at it as the same as buying, say, property and equipment, which is amortized over time from the balance sheet, you may have an argument. Now, there's obviously some component of R&D that is required to maintain Amazon's current business and should be seen as an expense or cost on the income statement, but a large portion is essentially investment for future growth. Now, I don't know what the split is, or does anyone else outside of probably management within Amazon. However, it's an important point to think about when valuing Amazon. And the point is really, Amazon could be more profitable if it wanted to. That's really the point we're trying to make. Now, you can see how consistent they really are on the R&D spend. I mean, it's obviously grown over time between the past decade, but over the past 5-6 years, like clockwork, it's been between 12 and 13%, meaning we can make assumptions about it going forward because it follows a fairly consistent trend. And for the purpose of demonstration, here is Amazon's EBITDA margin if we take out R&D as an expense on the income statement, or say just half it to account for the investment portion. Now, I wouldn't say you use this as concrete in your valuation, but like I say, it's definitely an important thing to think about if we're looking at how profitable Amazon can be into the future. Okay, so if we also bring free cash flow now into the equation, free cash flow is what we are interested in as investors. This is the money that is available to distribute to shareholders of the business or reinvest back into the business for growth. So in Amazon's case, they don't pay a dividend, they don't buy back much stock, as you can see from the shares outstanding. So they reinvest it all for growth, and I think that's the best way for them to spend it currently. Ideally, we are going to want to see this free cash flow number grow into the future, although it obviously has been positive for a decade. And I think as the business starts to grow, margins will improve. We've already seen that trend already, and also the free cash flow conversion will start to get better. Free cash flow has grown at a similar fashion to earnings, which is also good to see. It tells us that they are able to convert earnings into hard cash to distribute to shareholders, which is good to note, and also no funny business is going on with the earnings. Now, free cash flow as a percentage of EBITDA, that's what we're going to be using to project free cash flow into the future. We're going to project, obviously, a growth rate with the revenue, an expected EBITDA margin, and then a free cash flow conversion rate off of that EBITDA. Free cash flow seems to have the closest correlation with EBITDA from all of the other earnings metrics, which is one of the other main reasons why we are using EBITDA as our choice of earnings in this valuation. Consistency makes for the most accurate valuations. As you can see, over the past 5 to 6 years, the average rate has been around 72%, but with a, say, range of 65 to 85%, depending on CapEx. 72% is going to be the rate that we run with, projecting into the future, but it's likely it will improve as time goes on and the company slows growth, meaning that CapEx comes down slightly. So they don't tend to hold lots of cash, as we covered. They frequently invest and spend for growth. Debt is actually higher than cash, which usually I wouldn't allow, but it is Amazon. They will have no issues whatsoever meeting their debt obligations if it became a problem. I mean, as we saw, they could pay half of their debt off with their R&D spend, and then the rest off, obviously, with a year's worth of earnings. So it's not a massive issue for me, although it's not something I like to see. Shareholder equity or book value has grown at a tremendous rate, got 31% compounded over 10 years. As you can see, 7.5 billion book value all the way up to 82.5 billion in the space of a decade. This is really a sign of quality organic growth in a company, and not much companies you will ever find will have a rate of book value compounding like this. Okay, next I want to focus on the current valuation and past valuation of Amazon. So this part down here, as you can see, I've got the market caps, enterprise value, share price listed over a 10-year period, as well as the multiples or yields you would have paid for the stock during the period. Now, I'll probably focus on EV to EBITDA. It's sat around 39 times, 38 times over the 10-year period, quite consistently, but getting more expensive and cheap in times in between. Now, 39 times EBITDA is a very steep multiple on the face of it. However, there are two things I want to cover that start to make sense of this multiple in a more quantitative way than just saying it will grow. Firstly, if we touch on down here, EBITDA taking out R&D. Amazon is only selling at 19 times EBITDA if you back out this spending on R&D, which is a very attractive multiple for a business expected to grow earnings above 25 to 30% into the future. Just look at that EBITDA number, 84 billion, excluding R&D. It's just insane, to be honest with you. Next, the PEG ratio. Now, the PEG ratio is the multiple you pay divided by the 3 to 5 year growth rate. And this will become important later in our valuation. But what I want to show you now is how Amazon looked expensive 10 years ago at 39 times EBITDA or 37 times EBITDA even 5 years later. But it has managed to grow earnings at the same rate as the multiple, as we saw up here, 38% average annual growth rate, meaning it had a PEG ratio of 1 at the time. You essentially earned your multiple you paid as the IRR for holding the stock. So this is the theory of the PEG ratio evidence in a stock, to be honest with you. I think it was Peter Lynch who said, if your PEG ratio is 1, then the return you can reasonably expect from the stock is the multiple that you paid, as over the longer term, the stock performance will almost always mirror the growth in earnings. And this is evident in Amazon. I mean, the common theme here is 38, 39%, as you've got 38% growth in earnings, 39% IRR, 39 times market multiple, 38 times market multiple. You also would have earned back double what you paid for Amazon just in earnings, and then also had an opportunity to exit now at 22 times higher than what you paid for it back in 2011. The point that I'm trying to make here really is, don't be put off by the seemingly large multiple, not just on Amazon, but on other stocks. Sometimes it is pure speculation, but sometimes it is more than justified. All you have to do is look. Okay, so we have looked at the past performance and looked into Amazon in some depth. I want to show you my forecast for Amazon into the future. I've gone with a 5-year forecast just because, quite frankly, you can already see the numbers in 2025 get very large. So 10 years, putting it out 10 years, I had to really wrap my head around the numbers. So I'm going to go with 5 years. I think that's easier to get accurate projections based off of a 5-year valuation for Amazon rather than a 10-year. So one thing I will note is that 2020, I'm using the trailing 12-month numbers instead of a full year, or as the full year, which is conservative in of itself, as their guidance for Q4 suggested they were due to post quite big numbers that would raise the full year figure from the trailing 12 months. But I'm okay with that, rather be conservative than over bullish. In terms of revenue growth, which is going to be sort of the pinnacle of our valuation, I've gone with 25% to start, which is what they've currently got and expected to get in 2021. I actually think it's supposed to be a little bit higher, but we've got that trending down over 5 years, down to 12.5% by the end of the period, as would be expected as they get bigger. I mean, 794 billion in 2025. That's a very, very big number, albeit achievable for someone like Amazon, who has such a large footprint internationally in so many different markets. Over the 5-year period, that's an annualized rate of 18%, which is, if we slide over, just over the global e-commerce total addressable market annual growth rate, which is supposed to be somewhere near 15% for the next 7 years. So, as you could probably imagine, I expect Amazon to be the dominant force in that growth. They are the largest e-commerce player in the world at the moment, and quite frankly, the best. So I think 18% is fair to run with when they've got such a high growth TAM like that. And also remember, they are in cloud, they're in streaming as well, which are also huge growth markets. Okay, just touching on earnings now, on margins. So margins are set to improve with scale, as we've seen them do already. That means they have a margin of 15% in 2025 if we're following the current trend, which in turn means earnings grew at 22% over the period, which is unbelievably still actually under the consensus analyst 5-year estimate of 35%. But this is mainly measured against net income for the analysts, so should be taken with a pinch of salt. Now, there is the potential for earnings to be even larger than we are predicting. Obviously, if we covered the R&D spend and took 50% of it out, we say R&D drops down from the 11 to 12% that they adhere to at the moment, down to about 5 to 6% of sales, and we can get an expected EBITDA of 162 billion. Now, I'm not going to throw that in the model. It's just something to think about in terms of possible upside. Free cash flow is going to be our measure of value in this model, so we are needing to estimate free cash flow using a free cash flow as a percentage of EBITDA. Now, we covered this earlier. I'm going with 72%, which is the average over the last 5 years. And this is the closest really I could come to an accurate projection for free cash flow. Of course, as they grow, they may start to spend less on capex, which means that percentage of free cash flow percentage of EBITDA could grow. But again, we'd just leave that as possible upside. Cash and debt I have growing at 10% and 5% respectively, which gets us not to a significant cash balance or debt balance. It just means that cash starts to outweigh debt over the period, which you would expect as they start to mature and start to become less focused on growth. Shares outstanding remain the same, but I wouldn't be surprised if Amazon started a share buyback scheme with all that cash that they're going to have. And I'll demonstrate obviously how that affects the intrinsic value. Obviously, if they do start to buy back stock, the intrinsic value would be higher than we're currently running with now. And for our terminal value, which on this channel we like to use an exit multiple, preferably a conservative one, as terminal value makes up the majority of the present value. The market multiples that we could use are enterprise value to EBITDA, EV to EBIT, free cash flow yield, or price to free cash flow, or a PE. But here we're going to use an EV to EBITDA, as EBITDA is our earnings metric. And it also has provided the most consistent pattern in terms of a multiple over time for Amazon. And to help me come up with a fair multiple, we can look at here the relative valuations. Of course, we've got to think about how Amazon's going to get a lot larger. The growth rate is going to slow down, so there's going to be less of a premium on the stock. At the moment, it's trading at 39 times and quite consistent at that. So going off of this, we've got Apple maybe, which is a similar company, 26 times. Growth has slowed. Top line growth is in the low single digits. Earnings growth is still in the single digits. However, they buy back a lot of stock. So earnings per share seems to rise. So technically, you could see Amazon in that sort of position if they started to buy back a lot of stock as they got older and growth started to slow. So 26 times. Facebook, Google, around 21, 24 times. JD.com, an e-commerce play, a lot higher, but still growing. Alibaba, 26 times, but going through a tough stage at the moment. Online retail and e-commerce as a market is 23 times. The average of all of them is 26 times. So I think 25 times in 5 years is a fair market multiple for Amazon. So we're going to run with that for now, 25 times. Okay, so that is our forecast, basically. And now we have to put that into our valuation model to get the intrinsic value for Amazon stock. But based off of those forecasts, we get a target price for Amazon in 2025. We get a target price for Amazon in 2025 of 7,425 or 3.7 trillion. Those numbers almost sound too big, but people 5-10 years ago probably would have said it's crazy that Apple reached 2 trillion in market value, but it happens. Sometimes we're held back by what we can't believe or what we can't make a vision of just because we haven't seen it happen so far. So that's the target price based off of this forecast. And if we look at the valuation model based off of a 5-year DCF and a discount rate of 15%, which is my minimum acceptable rate of return, we get an intrinsic value today of 1.8 trillion for Amazon stock, or a share price of 3,500, which means it is 11% undervalued based off of this model. Now, the intrinsic value's obviously been taken from the free cash flow. So we've got a stream of cash we're going to receive over the 5 years, as well as the exit multiple that we're going to get. Now, because the numbers are so large, ideally for me, I would like to buy with a margin of safety. So I probably wouldn't buy at this share price or at the current stock price, although the stock itself has actually been on a little bit of a sideways track for the past few months, so it could spike up fairly soon, but I think I'd rather wait around to see if it does drop, and this would be more my buy price, although I don't know if it will ever get down to that share price again. However, if it did, I would buy more Amazon. However, if you haven't got any Amazon, it may be, according to this model, maybe a good chance to get into the stock depending on what your minimum acceptable rate is. As you can see, if you had a discount rate of 12%, mine's quite high at 15%, then the intrinsic value is up at 2 trillion, or a share price of 4,100. So way undervalued. 10% even more so. You've got 43% upside with a market discount rate of 10%. However, in my opinion, if you're okay with a 10 or 12% discount rate, really you should be buying the index if that is your minimum acceptable rate of return, and not take a gamble on individual companies. Of course, there's other catalysts as well that could help lift the intrinsic value. If we said that Amazon introduced a stock buyback scheme like Apple did and started buying loads of stock back, then we get an even higher intrinsic value up in the 4,000 share price, which means it's 26% overvalued. So I think, to be fair, we have left a fair bit of upside in the forecast. Although the numbers look very big, you can't deny that. We've trended down growth, we've tamed growth a bit. Margins have only grown up to about 15%, which they can easily do, especially when you look at the R&D spend and things like that. We haven't backed out any R&D. We've just made ourselves aware that that is a possible catalyst for higher margins. We've also left out the fact that they could buy back a lot of stock with those earnings. So I think we've left a little bit of upside in there. But yeah, the model's saying it is slightly undervalued. Let's jump into the IRR to just see in different scenarios what sort of return we can get from Amazon from the current price. Okay, so I've got three cases here. I've got a base case where we've got free cash flow growing at around 20%, which is the same as the model that we just looked at, is giving us EBITDA, and free cash flow tends to grow at about 20 to 22%. An exit multiple of 25 times and a free cash flow yield of 3.5%. And we're just taking the average of the two. The free cash flow yield is just essentially the inverse of price to free cash flow. But it's a similar sort of multiple to, or as expensive or as cheap as 25 times. But we're going to take the average of the two. And then we get terminal value of 4,600 in 2025, which is an IRR of 14%. A bearish case, which says that they can't grow free cash flow at the expected rate, it's going to be lower than that, so 15%, and the market's pricing it at a lot cheaper multiple, so 20 times. We get an IRR of 5%, so it could be bad if that bad scenario plays out. That's definitely not a return that we're looking for. And then we have a bullish case, so if we say free cash flow per share can grow at the consensus analyst estimate of 35%, and we've got EV to EBIT multiple, EBITDA multiple of 25 times, which is what we've ran within the model, there's an IRR available of 29%, which is a very, very big IRR. Although this would mean that Amazon would have to reach $7,500 per share for us to get that 29% IRR. So, as I said, the numbers do get very big. When you look at Amazon, it's already huge, already one of the biggest companies in the world by market cap, but also by revenue. But personally, I already own Amazon. It's been very good for me over the past year or so in terms of owning the stock. I don't know if I'd jump in at this price just because I do already have it. However, if I was new to Amazon, maybe I would look at buying this price depending on what I think it can achieve into the future. It's a great company with a great future, footprint in many different markets and internationally. So if that price drops below 3,000, I may well consider buying more. Okay, so there you go. My valuation and expected rate of return for Amazon stock. I have a buy price of, I have an intrinsic value of 3,500 based off of the model and a 15% discount rate. Personally, a buy price of just under 3,000 in my opinion. Please don't take this as financial advice, though, to go and buy the stock or even not buy the stock. Either way, do your own research and decide if it fits your investing goals and criteria. Let me know in the comments what you think of Amazon. Are you looking to buy Amazon, or is it just too high for you at this level? Leave a like if you enjoyed the video and subscribe for more investing content. It really helps the channel, as I said. But thanks for watching. Until next time, good luck with your investments.